Hi, Tony here. US equity markets finished lower on Friday, with tech stocks leading the retreat as traders reassess the broader AI trade. The rotation out of big tech has become one of the defining themes as we head towards the end of the first half of 2026. And this reflects renewed investor unease over the enormous AI related CapEx spend being undertaken by the biggest names and the increased uncertainty about whether those investments will translate into earnings growth that justifies the current lofty valuations. Looking ahead, month and quarter end rebalancing flows are likely to play some role in market movements over the next two sessions. While from a data perspective, all eyes will be on Thursday's non-farm payrolls report. Let's take a look at the Nasdaq and the Dow Jones to see how they're lining up at the start of this new week. All right, so the Nasdaq rally from the March lows, as we know, took us up 35% in 9 weeks. And from that point, we have seen the Nasdaq commence a correction. You can see what I've labeled a wave A, being the first leg of this correction down to this 28,196 low. Your wave B, or the second leg of the correction, followed by what I see as wave C, or the third leg. Now, providing this third leg comes into this support and holds around 28,000, I think you're probably looking for signs of basing before another leg higher for the Nasdaq. Now, if for whatever reason the Nasdaq were to break on a sustained basis below 28,000, then the chances are we are seeing a deeper correction, which potentially brings us back towards 27,000. So for this week, all eyes on this support area around 28,000. Now, for the Dow Jones has made a fresh record high last week, up at this 52,661 high, before falling about 700 points into the close. Now, what this retreat did do was leave signs of loss of momentum, both on the daily candle, which you can see here, this wick, shadow, or tail. And if you look at it on a weekly time frame, you can see similar. So what this means is we are seeing some signs of loss of momentum. Now, if you were to overlay that with the signs of bearish divergence, which we spoke about last week, of course, bearish divergence is when price makes a new high, but the RSI fails to do so. It probably suggests that things are getting a little bit stretched up here and that we need to be mindful that potentially we're going to see a pullback. For me, the first sign that this is playing out would be a break below support coming in around 51,300 to 51,200. If we were to see a sustained break, then you probably start to look towards this as being a short-term, possibly a medium-term top, and that the Dow Jones is coming back to test this support around 50,000. So watching very closely for a break of this support in the early part of this week for a sign that we're getting a deeper pullback. Now, if for whatever reason the Dow Jones holds above this support at 51,300, then there is certainly a possibility we can retest and break this 52,661 high, potentially up towards 53,000. But if I had to assign probabilities to what's going to happen, it is probably the first scenario I mapped out in terms of we are looking for a break below this support before a pullback into this region right around here. That's all for this week. Thank you for listening.